Wall Street Wrap-Up is supported by Bamboolas, featuring live music and coming soon, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.
This week on Wall Street Wrap-Up, there's a new speaker in the House, and he's from Louisiana. Ford and the UAW come to a tentative agreement if the rank and file signs on. So will GM and Stellantis be very far behind? It was the good, the bad, and the ugly, and not with Clint Eastwood, with good financial numbers and a strong GDP on the state of the consumer. So why was it so bad and ugly on Wall Street this week? Does the U.S. economy have a new billionaire? If you're wondering who it might be, we'll tell you later, and we'll do it swiftly. All right, I know it's a corny joke. Tonight, we'll be asking these questions, well, not about the Taylor Swift, but certainly about the state of the consumer, and more to Sam Stovall. Sam is the Chief of Investment Strategist at CFRA, and Sam's also the Chairman of the S&P Investment Policy Committee. Well, we might even ask Sam about Taylor Swift, too. That's Sam Stovall. He'll be with us coming up. We're here, you're there. And for the next 28 minutes, this is Wall Street Wrap-Up. Hi, welcome to Wall Street Wrap-Up. I'm Andre Laborde. It's October the 27th, and I hope you had a good week. And speaking of week, the Bureau of Labor Statistics released a number of the data on the health of the consumer right before the Federal Reserve meets next Wednesday. So for the year, the GDP of the economy is just blowing strong at 4.9%. Well, add to that, the consumer spending for September was up 0.7%, and the PCE, or the personal consumption expenditures, that also increased last month as well. Now, on the face of it, that's great news on the economy, but with inflation rate that's too high and the Federal Reserve wanting to cool off the economy, Wall Street was selling off this strong consumer data. Well, how did our money do this week? It was a negative week for all the stock indexes. It was the third week in a row for the NASDAQ and the second week of losses in the row for the Dow Jones and the S&P. Energy was the worst performer of the day, down 2%, and discretionary stocks had its best day in more than 3 weeks. And this week, the Dow Jones, they closed down just over 2% for the week. The S&P 500, they closed down just over 2.5%, and the NASDAQ, they closed down 2.6% for the week. Well, yesterday, Ford has made a tentative agreement with the UAW. This is depending if ratified by the rank and file. Now, it includes an immediate 11% pay rise to 25% over 4.5 years. But when you add into it the cost of living adjustment, that would be increasing to 30%. And the starting wage for new workers is going to increase by 64%. Ratification could be as early as this week coming, or maybe the following week. The current contract is paying Ford UAW workers $66.75 an hour, and with the new one, if ratified, would be paying just under $88 an hour. Now, in the third quarter of this week, Ford said that they'll be investing about $12 billion in EVs. But as you can see, the company made just over $1.7 billion in internal combustion engine vehicles. But the company lost just over $1.3 billion in the electric vehicle business. And that was in the third quarter. Since the beginning of the year, Ford has lost over $3.1 billion in EV sales. Consumers are wanting fossil fuel vehicles over the EVs. Well, the strike by the UAW has cost Ford, by their estimation, $1.3 billion, and the new contract will be adding an additional $850 to $900 to every new vehicle sold by Ford. The economy is strong, with personal spending for the September being reported by the government. That was jumping to 0.7% from the previous month in August, which was at 0.4%, which means consumers, for the most part in this country, feel good about having a job and keeping it, so they're spending. And the PCE, which is the personal consumption expenditures, that also came in high. Well, this measures the spending of consumers of goods and services. The annual GDP of just under 5% came in at 4.9%. the Federal Reserve is wanting to put the brakes on the economy to slow the rate of inflation. So with only 38 trading days left in this year, will there be a Santa Claus rally? October's always been, as this year, a very volatile month. And with consumer spending, will the Federal Reserve have to keep interest rates higher for longer? This is not what the stock market likes to hear, as there's an old saying in the stock market, when the prime is high, stocks will die. And when prime is low, stocks will grow. So you can see that along with a down August and September. How will November and December look? Take a look at the 7 high-flying stocks known as the Magnificent Seven. Well, from their highs, Amazon and Apple are now down from their highs almost 16%. Tesla is down just over 31%. So let's find out how the last 2 months of 2023 will look in the stock market with all that data. What does a Federal Reserve look at when deciding next week to either raise rates or having a pause? And will this stronger data this week hurt the hope of the Fed to pause? And when will they cut from the present 5.5% that they presently have in place? Sam Stovall is the Chief Investment Officer of CFRA, and he's also the Chairman of the S&P Investment Policy Committee. Hi, Sam. Welcome to Wall Street Wrap-Up.
Hey, Andre. Happy to be here.
Sam, let me paint you a scenario. Okay, so we've got October is going to be ending middle of next week. And to say October's been volatile, I guess maybe you might want to even say it's an understatement. You know, it's been topsy-turvy. November starts next week. August has been down. September has been down. October, probably, maybe down too, maybe. But from January the 1st until the first half of this year, from January 1 to June 30th, S&P was up about 16%. What do you think November and December is going to look like?
Well, I think that we're going to end up on a high note, but let me go along with what you were just saying before. Yes, October is by far the worst month of the year. Since World War II, it actually has had 35% more volatility than the average for the other 11 months of the year. And it's typically known as a bottoming month in that more than twice the number of declines of 5% or more ended in October as compared with any other month of the year. So it's usually when things look the darkest that represent the greatest opportunity for investors, and maybe that's what we're getting right now.
About 3 weeks ago, the S&P was about 4350, 4340 or so, and you had said that S&P would probably may get to around 4,200-ish, and that's going to be about a bottom. But lo and behold, S&P right now is about 4,200-ish. Is this the bottom you were talking about a month ago?
Well, it was the target that I had mentioned a couple of months ago for a variety of reasons in terms of the amount of decline from a technical perspective, looking at the 200-day moving average, basically looking at things that implied the kind of decline that we were likely to see. And we are there now. And I would tend to say that, yes, longer term, this will probably end up being a good buying area. But nobody knows for sure, so we might end up going a little bit further to the downside. But I tend to think that there's an awful lot of negative news that has already been worked into the system. People have an awful lot of reasons why historically things have looked bad so far this year, or at least since July 31. As you mentioned, the market was up so strongly, but I think that the market just got too far ahead of itself. The NASDAQ was 26% above its 200-day moving average, and even General Patton didn't get that far above or ahead of his supply lines. You know, he basically had to stop and wait for them to catch up.
Of the S&P 500, we have 500 stocks, but of those 500, we've got like what they call the Magnificent Seven, you know, the seven horsemen. But you've got the other 493. Do you think that those seven are maybe overbought, or are the other 493 underbought, underweight right now?
Well, I think if you had asked me that on July 31, I would have said, yeah, the Magnificent Seven really has had their day in the sun, and they could end up paying for it in the near term. Right now, through last Friday, only about 13% or so of the stocks in the S&P 500 were still up on a year-to-date basis. About 38% of them were beating the market. So I think that we've had a pretty good washout. Maybe there could be a little bit more downside to go. But I also then point to history. The fourth quarter of the pre election year for first term presidents has never declined, and the average total return has been close to 6%. I think that with us starting at such a low point because of where we are in October, that gives us a good opportunity for the remainder of this year, primarily because Wall Street starts to look more than a year out. Instead of making forecasts on 2023 full year earnings, they focus more on 2024 results when all 11 sectors in the S&P are expected to post positive returns, with 5 of the sectors expected to post double-digit gains in earnings. So I think investors are basically saying, yes, this year has been a challenge, but just almost like sounding like Brooklyn Dodgers fans, just wait till the next year.
Well, Sam, that's a good point. So in a pre-election year, which is what we are in right now, and as I brought up earlier, between January the 1st to June 30th, the first half of the year, I think I've even heard you say, so when the market is up like 10% or higher, like you just said, it ends the year up about another 8%?
Very good. Well, thank you for reading my articles and even more so remembering what I said.
I tried, Sam.
Well,
Yeah.
you get an A plus, so thank you.
Thanks.
Yeah, absolutely. I mean, when you look to history and we were up as much as we were, even if we were up 100% of the time, it's never a guarantee that that would happen, but it certainly is a comforting statistic. Also, whenever the market was up, on a year-to-date basis through the end of September, as we were this time around, we were up 10%. The market was higher for the full year 96% of the time. Only 2 times since World War II did we end up giving up the gains, but they were nowhere near as strong as they are this year in those 2 other periods.
Well, next week, November the 1st, the Federal Reserve is going to meet again. And right now, I would say that we're in a rising rate environment. They may pause, but if we're in a rising rate environment, I think one time you had said that in 1987 was the other time that we were in a rising rate environment. Do you think that we're still in the possibility of a recession?
First off, yes, I think we are in a new bull market. We recovered 83% of what was lost in the prior bear market. We have never been in an advance off of, a 20+% advance off of a prior bear market by more than 60%, only to turn around and then fall before reaching a new all-time high since 1949. So that says, yeah, I think we're in a bull market and that it's likely has legs, and we will probably hit a new all-time high before, like the messenger from Marathon, we stumble from exhaustion and end up turning substantially lower. I think that the earnings, as I had mentioned, are expected to be pretty strong. A headwind is certainly higher interest rates, with the 525 basis points or 5.25 percentage points that have been risen over the past year and a half or so by the Fed. That's basically the quickest tightening that we've seen for many, many decades, and has certainly put the brakes on lending, on borrowing, et cetera. But amazingly, we're going to get on the 26th of October the GDP report for the third quarter. The consensus is looking for about 4.3% gain. Our economists are looking for 4.8%. And the Atlanta Fed itself is forecasting a 5.4% jump. So we don't think that we're headed for a recession, certainly with this Q3 number, even though we do think the fourth quarter of this year and the first half of next year will end up being closer to about a 1% gain. So economic softness, but probably not an outright recession.
Sam, when it comes to data, like you just brought up, we're going to be having the GDP numbers coming up the beginning of every month. We always talk about the unemployment rate, job gains and such, and also CPI. Is there one type of data that the Federal Reserve looks at more than others, with all the different types of data coming out, whether it be from the Commerce Department or the Bureau of Labor Statistics? What do they look at?
Well, Andre, they have a dual mandate, meaning they want to keep inflation low while at the same time trying to keep employment high. So obviously, they're going to look to the employment data to see what the unemployment rate is, what the rate of growth is. But within that, it's almost like peeling away the leaves of an artichoke. Look at the heart of the matter in terms of earnings. They want to make sure that the earnings portion is not rising too dramatically, because earnings represents a bulk of the inflation measures. We have a variety of inflation measures out there: the Consumer Price Index, or CPI, the Producer Price Index, which is more of a wholesale indicator. That's the PPI. We have the PCE, which is the Personal Consumption Expenditures, and that happens to be the Fed's favorite indicator. But it also likes to look at that on what's called a core basis, meaning ex food and energy. A lot of cynics say, well, sure, of course, we're not going to we're not going to heat our home or drive our cars. Well, the reason the Fed does not look at that is because they have no control over the weather or over planting cycles. And they don't want to be focusing on energy prices too much, because obviously OPEC could then wreak havoc on our monetary policy. So the Fed basically looks at unemployment data on a monthly basis, and then the PCE on a core, particularly year over year, which when it is reported later on this week, they will likely see another down step, which will be encouraging to investors.
Are you surprised, Sam, at just how resilient the economy is?
I am, because as you can tell already, I'm a big student of history.
You
And
are.
history basically tells us that whenever the CPI was above 6.5%, we fell into a bear market with a recession. Whenever we had leading economic indicators negative year over year, that led to a bear market with a recession. Whenever we had inverted yield curves, as we do today, meaning that it costs more to borrow on the short end than it does to lend longer term, even if your brother-in-law is the banker, they're not going to lose money lending money to you at less than what it costs them to bring in those funds. So also we are in likely the fourth consecutive quarter of earnings declines, which is known as an earnings recession. And traditionally, an earnings recession has accompanied an economic recession and a bear market. We're not seeing that this time around, possibly because a lot of these problems, if you will, were the result of the COVID lockdown and then the stimulation that took place to bring us out of it.
Well, do you think as we mentioned before, how November 1st they'll be meeting, the Federal Reserve will be meeting, and they're going to meet one more time before the end of the year in December. Do you think so? Do you think there'll be a pause this time? And what about December? Or is it too early to tell?
Well, our best guess, if we had to put our feet to the fire, we would say the Fed is done, and that the Fed is not going to be raising rates again, and will start to cut interest rates beginning sometime in the third quarter of 2024. Historically, the Fed has taken about 9 months between the last rate hike and the first rate cut. This time it could be higher for longer, but I think once the market gets the sense that the Fed is truly finished, we will likely see an upward move in the market, as we have during all bull markets or pause periods going back to the late 1980s. You're absolutely correct. Back in 87, things were a little bit different, like they are this time. That bull market was in the face of higher interest rates, which is what we're experiencing now. Whereas all of the other bull markets, especially those that look at small cap stocks since the early 1980s. Small caps beat large caps by a 2-to-1 margin. This time they are underperforming by about a 2-to-1 margin. So things are definitely different this time around. But I would say that the Fed on November 1st will tell us that they are not going to be raising rates again, but they are going to say that the job is not done. They're going to continue to monitor the data. They're going to wait and see what happens before making a decision for December. But certainly there is a possibility of a final rate hike of 25 basis points or 1/4 of 1% in either this FOMC meeting, the December or the January one. But our thought is they're probably done already.
Even if, let's take a scenario, Sam. Let's say hypothetically in December, because they don't want to seem dovish. Okay, so let's say they raise it 25 basis points in December. Do you think the market will just shrug it off, thinking, well, like what you're saying, they maybe just want to do one more, or do you think this would have an adverse effect?
I think it would be taking a lot of investors by surprise. If they did it in November, it would almost take everybody by surprise because there is something on the web called the CME Fed tool, which basically surveys strategists to say, all right, how many of you think that the Fed will be raising rates? And 99+%, ivory so pure, if you will, say no rate hike in November. And it's a less than 30% chance of a rate hike in December, and also a fairly low, less than 50% possibility of a hike in January. And actually, more and more people are saying there's a possibility that the Fed will be cutting rates by December or even January if the economy ends up slowing quite precipitously.
Sam, what about the Middle East right now? I mean, it's with the Israeli war with Hamas terrorists. We've got Ukraine that's been going on for over a year. Something may happen with Taiwan, with China. What about the price of oil? You were just mentioning about we're being in a bull market right now and things are looking good. With black swans, if oil goes higher, well, I'll ask it this way. Do you think oil will go higher? And if it does, what would that do to the economy that we were just talking about?
Well, oil is still a very important commodity within our overall economy because even though electric vehicles are picking up steam, if you will, basically it's still very much a fossil fuel driven economy. So I would say that energy still is important. Our feeling is we'll probably end up seeing oil prices average between 85 and 90 through the end of this year, and then average around $95 a barrel for 2024. But I got to say that our forecasts are pretty much as slippery as the commodity itself because it's very hard to forecast accurately what oil is likely to do. If we do find, however, that oil prices go up dramatically, in many ways it becomes a self-correcting mechanism. For every $10 increase in the price of oil over an extended period tends to erode anywhere from 20 to 25 basis points of real GDP. So what happens is that if gasoline costs too much, then people end up bunching a lot of their trips together. They tend to economize. A lot of times you do end up with demand destruction if oil prices end up going too high.
Let me throw another, maybe you can say a black swan in there as well, too, like we just talked about oil. Coming up next month, November, the Congress, if they ever do find a speaker, they should be trying to decide whether or not to raise the debt ceiling. Now, I've read where you've said and if my number is correct, since 1976, we've had something like 20 debt ceiling shutdowns. First, I'll let you take it from there. What happens, do you think, in mid-November if it makes now 21 shutdowns?
Well, very impressive. You've done your homework and you have good memory.
Thank you.
Yes,
Thank you.
there have been 20 government shutdowns since 1976. And it really ends up being more of a headline event than a bottom line event. Wall Street tends to yawn because on the week before the shutdown, the market basically went nowhere, and 50% of the time plus it was higher. The day of the shutdown, the market essentially went nowhere, but more than half of the time, the market was higher. And for the entire shutdown period, which did average 9 days, the market also went basically nowhere. One reason is that a lot of times government shutdowns take place just before weekends, even long weekends. And so what happens is it ends up angering tourists more than it does traders. I think when you look to Congress right now, all you can say is it reminds me of the old saying that if the opposite of pro is con, then the opposite of progress is Congress. And so I think that because we are coming up to an election year, the people who are in, D.C. better get their act together, or there'll be other people in a majority of their seats by this time a year after. So I would tend to say they really need to get their act together. A lot of the Republicans will probably end up getting blamed if we do end up with a government shutdown, and we just can't afford to be shut down as much as we are right now, let alone after the debt ceiling debate takes place later in November. So,
And I hope you come back. I thoroughly enjoyed having some time with you.
well, it's been my pleasure, Andre. I hope you do invite me back. Thank you.
Thank you, Sam. Hey, if you've got a question, maybe a comment about the show, we want to hear from you. Make it concise, make it pithy, and write us at andre@benecapital.com. And now, time for a wrap-up on Wall Street. Well, does the United States have a new billionaire? Bloomberg is reporting that Taylor Swift is hitting that mark due to the massive success of her Eras tour. Now, Swift's 53 concerts this year will be adding $4.3 billion to the U.S. economy, and the average ticket cost is now at $254 per ticket. As many Swifties I know are paying much more than that in the secondary market and also in scalping prices. Well, a couple of weeks ago, we had investor Steve Eisman on the show. And for the movie fans out there who enjoyed The Big Short movie, actor Steve Carell's character was modeled after the real-life investor Steve Eisman. Now, we had taped Steve, and because of time, we had to edit a portion of that interview out. Well, next week, we're going to be showing the full interview with his views on the health of the banking system, credit in the United States, and is he shorting anything right now for this year and into 2024? That's Steve Eisman next week. Well, that's a wrap-up for our show for this Friday, October the 27th. Our thanks to Sam Stovall for being with us tonight and this evening, but always we appreciate you for allowing us into your homes tonight. Have a fun weekend with the ones you love, and by the way, have a happy Halloween. Remember, if it's Friday, it's Wall Street Wrap-Up. I'm Andre Laborde, and always remember, money never sleeps. Good night.
Wall Street Wrap-Up is supported by Bamboolas, featuring live music and coming soon, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.